Zaid Mortgage Broker. What's going on, everybody? Today I'm going to talk about a very important topic, and it's something that's going to benefit your life. If you are, you know, always looking at mortgages, if you're first time home buyer and you're checking out mortgage rates, or if you're a homeowner and you want to look at rates where they're at, I know if you got a 2.75, you're probably not looking at that stuff, right? There are some homeowners that got really, really lucky. I wouldn't say lucky. I would say blessed in 2020 and locked in a 2.75 rate. I bet you those guys aren't even peeking at the rates. They don't care if the Fed rate dropped or went up. They're not concerned, right? Those guys, they're paying off their homes. All right. I don't know about the rest of us. Okay. I don't know about I'm just kidding. I'm just kidding. So everybody thinks that the Fed controls mortgage rates, but they don't. All right. The Feds do not control mortgage rates. The Fed doesn't set mortgage rates at all. All right. You ready? Wall Street does. All right. You know those guys in the business suits and the ties down in the Wall Street, right? With the big skyscrapers and the buildings and all the money in the world. Those guys control the mortgage rates. Okay. The Fed rate controls overnight bank to bank lending, which means small, fast debt like car loans, personal loans, credit cards, lines of credit, right? Those type of things are affected by the Fed rate. So if you ever hear the Fed rate go down, don't call your mortgage broker. I'm going to give you something and I'm going to tell you what to do to find out yourself. You can definitely call me, but don't call yours. Call me. I'm just kidding. So, mortgages are bonds. I'm going to tell you how mortgage rates are affected, right? They're bonds. When you get a loan and it closes, it's sold as a mortgage-backed security. It's called an MBS, and they're sold to pension funds, hedge funds, and other institutions, right? Those investors that are buying these bonds demand a yield. They demand to get paid. So, they move based on what the bond investors require, not the Fed. Okay? So let me say that again. They move based on what the bond investors require. They require to get paid a certain amount of money. All right? And if they're not coming in like that, they require it to go up, they require it to go down, or they just don't buy them. And if they don't buy them, it's not bad. Then they got to make changes. And if they buy them, then it's good. They go down. Something like that, right? Whatever. I'm going to make it very simple, okay? Because I want everybody to understand this. I want everyone watching to understand this. And the way you can tell is by this chart here, the 10-year Treasury, okay? The reason mortgage rates follow the 10-year Treasury is because the average mortgage is paid off or refinanced within 7 to 10 years. And when you say paid off, you might think like the homeowner paid off the house. In these times, I don't think nobody's paying off their house. Okay, so this is probably all refis. All right, because when you do a refinance, your old loan gets paid, you get a new one, right? Obviously. So the average homeowner is probably just refinancing. They actually do over their lifetime. They refinance about 7 times. That's the number. So investors price mortgages based off of the 10-year. So what you do is very, very simple. All right. You don't have to be, quantum finance to understand this, okay? When the 10-year goes up, rates go up. When the 10-year goes down, rates go down. So look, right here, last month, at the end of November, rates were lower than they are now in December. And the Feds made an announcement that they cut rates. So this proves right here that the Fed rate has nothing to do with mortgage rates. All right. My clients call me. This is the third time or second time the Feds cut rate. They call me. Every single time they call me, I tell them the same thing, but they still call me. Hey man, the Fed rate went down. What's my mortgage rate? Hey, can you refinance me now? You drop my rate now? I can't drop your rate now. No. Did you check the 10-year Treasury? All right. Inflation is still bad. Unemployment is still bad. Things aren't looking good. Investors aren't wanting to buy these mortgages. They got to become more expensive so that they can, come on. Check the 10-year Treasury. All right. So that's your tip. Mortgage rates, move based on inflation, recession risk, and bond demands, right? Not Fed speeches. This is a perfect example. When did the Feds have their meeting? Fed meeting. It was in December. They had two, I think. December 10, 25 basis points. Let's see what happened December 10. All right, it went down, right? Could be hype, could be speculation. But look, no, look, it went down December 10, that same day. But look what happened the next day. Could we say that the Fed's cutting the Fed rate made it worse for mortgage rates? Could we say that based off of this, 4-day analysis? Look, December 8th before the Fed announcement, December 10th on the Fed announcement, December 11th the next day. And this was higher than when it was before they made their announcement, which means rates are higher now after their announcement. They were lower before, right? Look at the chart. Then they went back down. Then they kind of balanced out. So if you're going to take anything from this video, it's going to be to check the 10-year Treasury. And remember, the Fed rate does not set mortgage rates, all right? Everybody have a great day. If you need my help, I do mortgages. I've been doing it pretty much my entire professional career, and I love it. I can do any type of loan, no income, bank statements only with no tax returns, mixed use, ground up construction, seconds on an investment, no FICO, hard money, no appraisal, 5 days. I'll get it done. Let me know. All right, everybody have a great day. Goodbye.